Yeah, hello out there. You're welcome to another video series from Investing Cube. My name is Eno Eten, a market research analyst with Investing Cube. So we're going to be looking at the performance of some assets this week, and we're going to start off with crude oil. So today, crude oil crossed the $93 mark, and this is translated to a rise of about, if you look at the charts, about 1.72% as of writing. Now, this is about the fourth or fifth straight session that crude oil prices have risen. And the reason for this is not too far-fetched. It's tied with the geopolitical situation in the Middle East. Now, within the week, the previous framework for the ceasefire that was announced about 2 months earlier between the US and Iran expired. And due to the expiration of this framework without a concrete deal being put in place, the markets have begun to price in a prolonged closure of the Strait of Hormuz. The previous market sentiment was that the closure of the Strait of Hormuz and the entire geopolitical situation was not going to be a long one, it was going to maybe last for 2 months or 3 months. But right now we are into the sixth month of this situation, and the end doesn't look to be anywhere close. So right now the markets are pricing in a more prolonged conflict and a more prolonged disruption to oil shipping. And this is creating a supply shock to the market, and that is why crude oil prices are trending higher. Okay. Now, what this does is that it also raises inflationary concerns across the world. And so, for currencies of economies that are dependent on crude oil imports, the situation isn't really a very good one. Okay. So, what we have here is that crude oil has breached the resistance at 91.37 and is currently trying to cut a pathway towards the next resistance level somewhere at the $102 mark. However, there is a temporary resistance located somewhere around 97.7. This is where you have the cluster of highs of early June, and it's likely that this price level will be a pit stop which the bulls have to overcome before they can get access to the next resistance point at 102.00. Okay, so that's it for crude oil. The sentiment is bullish, and the break of this resistance at 91.37 has unlocked access to the next resistance level at 97.72. If this is the sentiment that continues to the end of the week, we can expect crude oil prices to keep pushing higher. Okay, now we're going to shift on to gold, which is currently trading at 4,406. It had actually gotten as high as 4,524 on Wednesday when the FOMC minutes were released. Now, what really happened was this: the FOMC minutes itself noted that the Fed policymakers were getting more concerned about the increased inflationary expectations. So, the minutes of the meeting held 28-29 July 2026 revealed growing inflationary concerns and a broader openness among the policymakers to raising interest rates, okay, which are currently at the 3.50 to 3.75% band. Now, this is actually a hawkish tone. So the question is, if we had the FOMC minutes that were really hawkish, why was it that the US dollar weakened relative to gold prices? Now, what really happened was that if you look at the market action on Wednesday and Tuesday, we saw US long-term bond yields spiking to multi-decade levels. The 30-year Treasury notes had actually hit 19-year highs above 5.3%, and The 10-year note, which is typically the long-term yield benchmark, had also hit 4.74%. So in order to cap the rapid spike in bond yields, the US Treasury performed an unexpected move on Tuesday, where they typically said they were going to double the size of the liquidity support buyback operations for longer dated notes and bonds. What that really means is that the US Treasury has now resumed an aggressive bond buying program, and this is going to cap the skyrocketing long-term borrowing costs. And what this has done is it has forced down the US 30-year Treasury yields sharply. Okay, and because of the sharp drop in bond yields, we're starting to see demand moving away from the US dollar denominated assets back into the metal assets. Okay, and of course, gold on its own is also a hedge against inflation. So you have a combined effect of traders now wanting to hedge against the expected increase in inflation that's going to come in the coming months because of the unresolved nature of the Middle East geopolitical situation that is leading to higher oil prices that have topped $90 a barrel. And at the same time, they're also trying to get some value from the move of investment flows away from the US denominated assets, which have been hit by the artificial bond buying program that is going to cap the yields on long term bond yields. So, the double impact of what's happened in the market in the last 2 days is what has now translated into gold prices topping the 4,500 mark briefly before we had the pullback today. But even after the pullback to as low as 4,450, we are seeing gold prices pushing back up again. Currently, gold price is at 4,496, 497, and so the 4,500 psychological resistance is about to be retested. Okay, and we also saw a report today out of the Goldman Sachs research desk where they're basically saying that they expect gold prices to hit the $5,000 mark sometime in 2027. So what you really have on gold charts is that the trend and the sentiment remains bullish despite what has gone on in the last few months, okay, where price has basically been a two-way consolidation. So right now, we are actively looking for gold to breach the 4,509 resistance mark. And if price action is able to break this resistance right here, we could see a push all the way to 4,584. Now, to get this upside move in context, we need to look at a 4-hour chart where we see what happened earlier in the week. Basically, what we had here was a double bottom pattern, and the 4,433 neckline resistance was breached yesterday after the FOMC minutes. So really, we are looking for a price move that is actually going to complete the measured move from this point to the neckline, and that comes in somewhere at 4,584. So we're still looking for gold prices to breach this resistance and push up to 4,584 in the near term if the current sentiment continues. Right now, you're seeing the 4,500 mark now being tested by the upswing in gold prices intraday. Okay, and so that's it for gold. And we end this video series with a look at the British pound. Obviously, the employment data that came in yesterday was, that came in on Tuesday was actually supportive for the pound because we had a claimant count that came in lower than expected, and we had the unemployment rate that also came in lower than expected, and we had the average earnings index that came in slightly higher than expected. Okay, and on Wednesday, that was yesterday, the CPI on year came in at 2.9%, which basically met the market expectation, so there was no surprise there. So what we've seen is that the British pound has been gaining ground gradually against the yen and against the US dollar. So right now on the GBP JPY, we're seeing an uptick again in the pair. The British pound has advance against Japanese yen, and you can see that the 216.03 resistance has been breached. So the price action is right now on its way to the next upside target, which is at 217.23. That's where you have the next resistance, which is formed by this low here, the low of 29th July. Okay, and don't forget, Japan imports most of its energy needs, and so the yen is also taking some pressure from the rise in oil prices. So what you're really seeing here is that the GBP is now in advanced move. The trend remains northwards, and having breached this resistance right here, we expect the uptrend to continue. Okay, we also see the same trend going on in the GBP USD, where the US dollar, of course, we mentioned why the dollar lost ground yesterday, and this was due to the resumption of the aggressive bond buying program by the US Treasury. So we see again the British pound has further gained ground against the US dollar, and it's now in the second day of gains. Right now, the pair is up 0.21%, which translates to a move of 28 pips on the day. And this adds to the 72 pips that the pair gained yesterday after the FOMC minutes. So again, we're seeing the GBP now targeting the upper range of this consolidation area we identified earlier in the week. If you look at our video release on Monday, you see where we identified these boundaries: 1.3663 to the upside and 1.3172 to the downside as a medium-term price range. So we're seeing the British pound US dollar pair testing the upper limit of that range. And if 1.3663 is breached, we're going to see the British pound USD pair advance a lot further, with the highs of 5th February at 1.3785 now serving as the next upside target. However, if the bears are able to resist this upside by causing a rejection here, then we would expect prices to retrace and retest the 1.3518 support. So I hope you've been able to get a hang of what has happened this week in the currency markets, and we do hope that you could take this information and do something with it in your trading activity. Thank you very much. Once again, my name is Eno Eteng. I'm a certified financial technician and market strategist for Investing Cube. Have a nice weekend ahead. Till we see you next week. Bye for now.